Welcome to Card Table Commentary. I'm your host, Seymour Peterson. When we began Card Table Commentary, we said we would try to explain how the old economics turned into the new economics. At the beginning of the 21st century, the U.S. was still committed to policies like balancing the federal budget, trying to avoid additional federal borrowings and debt in general. And interest rates were determined in the market by the duration and risk of the obligation. Savers had available safe investments that would return at least the rate of inflation. But more important, the old economics, when it was discussed, was denominated in billions of dollars. But within 10 years of the start of the 2000s, it was replaced by a new economic regimen, and it had to be denominated in trillions. How could principles that had seemed to have served us well for over 200 years be overturned in just 10? At the time, nobody really explained why this was necessary, but it was thought that at the time we were in a heap of trouble, and bold new approaches had to be made. And pretty soon, we found ourselves functioning under a whole new set of economic rules. Now, another 10 years later, people are starting to question whether the economy can continue to function under these new rules. What happened in between to justify such extreme changes? The 90s were a period of exceptional economic growth and exceptional investment returns, but they were a hard act to follow. In these investment markets lurked problems. The chairman of the Federal Reserve, Alan Greenspan, called it irrational exuberance. Whatever it was seemed to cause optimistic investors to bid the prices of stock well beyond what the underlying values were. And as a result, there was a big market crash. Starting in March of 2000, the market went down for basically 3 years. And the S&P went down by 35%, but the NASDAQ, where most of the new companies and the internet-based companies were that really caused the market frenzy, it went down a full 80%. And the resulting what we call a poverty effect, with people losing money in their portfolios, was in contrast to the wealth effect that had helped the 90s economy go along. One might, looking back, wish that something would have been done to prevent this from happening. And maybe the Federal Reserve could have drastically increased interest rates and caused the economy to slow down and caused investors to take a second look. But based on the underlying growth trends and the inflation trends during the 90s, it's hard to say that the policies that the Federal Reserve followed were unreasonable. They were pretty appropriate to the times. I think instead, when you have an investment mania like we had in the 90s, that it comes from psychological and emotional things that motivate investors. Back in 1841, a guy named Charles Mackay wrote a book entitled Extraordinary Popular Delusions and the Madness of Crowds. And in it, he tried to analyze some of the investment bubbles that had occurred up to that time, and he developed a theory about why these things happen. And I would say that policymakers need to read that book and familiarize themselves with what makes a bubble and how to recognize it. These investment bubbles have caused most of the economic downturns throughout our history. The Great Depression, many of the banking crisis and stuff back in the 1800s were caused by markets getting overly optimistic. And it's very difficult to tell when you're in a bubble. Everybody wants to believe it can keep going up, and some people are making money. They don't want to have it be reversed. As an example, I was so convinced that the 90s market was in a bubble that I sold a futures contract on the NASDAQ 100 in February of 2000. It had just seemed to me that it was so high that it was bound to come down. Well, after I bought it, the market continued to keep going up so much that I was taking big losses on that contract. And so I finally chickened out in early March and sold it and took a big loss. And then eventually it was just a couple of weeks later that the market broke. And if I could have held on to that contract, it might have been worth $80,000. But that's the nature of a bubble. And another thing they say is the trend is your friend. And the trend usually pays off for people. And the people that are benefiting from the bubble want that trend to continue. And it's really hard to stop. The falling stock market wasn't the only cause of the poor economic performance in the 2000s. Imports continued to rise and transfer more and more U.S. jobs overseas. Then there was the catastrophe of 9/11 and the expensive wars that followed it. Investment bubbles and the intrinsic mismatch between the short-term deposits that savers provide banks with and the longer-term loans that bankers make with those funds has dogged the U.S. economy since its inception. Besides the bubbles, this mismatch in duration of deposits and loans frequently causes problems for us. In the 2000s, a new financial crisis resulted from both of these effects. This time it was based on real estate and real estate financing. In the next installment of Card Table Commentary, we're going to try to sort through what happened and show how the response birthed the new economics.